Good afternoon, class. Good afternoon again, wherever you are. Good morning, I don't know. Today we will cover chapter 6. Chapter 6 deals with international parity relationships and forecasting foreign exchange rates. So let's get started. Here is the chapter outline. We would cover interest rate parity. We will cover purchasing power parity. We will talk about the Fisher effects. And finally, we will conclude by talking a little bit about the ways in which exchange rates can be forecast. So that's our task this afternoon. Now, international parity relationships. There's something in finance known as the law, finance and economics really known as the law of one price. Okay, the law of one price is the requirement that similar commodities or securities should be trading at the same or similar prices. In other words, if you have two identical assets or commodities, they should command the same price, irrespective of where they are being traded. The law of one price prevails when the same or equivalent things are trading at the same price across different locations or markets, thus precluding profitable arbitrage opportunities. You know, Now, arbitrage is the act of simultaneously buying and selling the same or equivalent assets or commodities for the purpose of making certain guaranteed profits. So if you can make money without risking anything at all, okay, that is known as an arbitrage profit. Now, interest rate parity is an arbitrage condition that must hold when international financial markets are in equilibrium. Okay, interest rate parity is a manifestation of the law of one price applied to international money market instruments and provides a linkage between interest rates in two different markets. Now here's an example of interest rate parity. Suppose you have $1 to invest over a 1-year period. You will only consider default free investments. These are investments for which there is no risk. So here we're thinking of let's say treasury bills, for example, or treasury bonds or treasury notes. Okay, there are two alternative ways of investing your money, right? You can invest domestically. Okay, if you're in Canada, you can invest in Canada. If you're in the US, as is my case, you can invest right here in the US. Okay, so if you choose the option to invest domestically, right, the maturity value in 1 year will be $1 times 1 plus the domestic interest rate. And since I'm looking at this from the standpoint of the US, I subscript S is the US interest rate, is the 1 year US interest rate. Now, alternatively, you can invest in the UK, you can invest in the United Kingdom, right? If you do that, you'll be investing at the rate that prevails in the UK. Right? So this option requires the following steps. You would exchange $1 for pound. That is, this expression here is the amount at the prevailing spot exchange rate of S. So first of all, you would exchange your US dollars into British pounds, and then you would invest the pound amount at the UK interest rate. I subscript a pound is the interest rate in the United Kingdom. So at maturity, you will have this value here, right? You have this value at maturity. But what you want to do is lock in that value. So how can you accomplish that? You sell the maturity value of the UK investment forward. So you use the forward market to lock in your gain. Okay. So F in this case is the forward exchange rate. Okay, so once again, you sell the maturity value of the UK investment forward in exchange for a predetermined dollar amount. That is this amount here is predetermined. So this is a way of locking in your return. Now, the effective dollar interest rate from the UK investment alternative is given by this expression here. This is the effective dollar interest rate, right, from your UK investment. Okay. UK and US investment examples are equivalent. Okay. So future dollar proceeds from investing in the two equivalent investments must be the same. This implies this expression, that is 1 plus interest rate in the US must equal the forward rate divided by the spot rate times 1 plus the interest rate in the UK. Now, if you solve this expression for F, you get this expression here. So these two expressions are equivalent, right? They are equivalent expressions. Now, interest rate parity can be derived by constructing an arbitrage portfolio which involves the following. No net investment, in other words, there's no out-of-pocket, no risk, okay, because again, you're engaging in, you are utilizing risk-free assets in your strategy. No net cash flow generated in equilibrium. When interest rate parity does not hold, the situation gives rise to covered interest arbitrage opportunities, allowing a certain arbitrage profits to be made without the arbitrageur investing any money out of pocket or bearing any risk. This is a point that I made earlier. Interest rate parity and exchange rate determination. How could we use interest rate parity in our quest to determine the equilibrium exchange rate? Okay. If you reformulate the interest rate parity relationship in terms of the spot exchange rate, you get this expression. Okay. Okay. Now, the forward exchange rate can be viewed as the expected future spot rate, conditional on all relevant information available. Okay. So this is the forward exchange rate. It can be regarded as the future spot rate, conditional on I subscript T, where I subscript T is the set of information that is available at time T, which is the current time. Okay, and S subscript T plus 1 is the future spot rate when the forward contract matures. So for example, if the forward contract is going to mature in 3 months, then ST plus 1 is the spot exchange rate that would be in place in 3 months. So combining these two expressions here, combining this expression and that expression gives this expression here. Okay, so you can see that the spot rate is the ratio of 1 plus the interest rate in the UK over 1 plus the interest rate in the US, right, times the expected spot rate at time T plus 1, conditional on information that is currently available. Now, two things are noteworthy from the following equation. This is just the same equation that was presented in the previous slide. First, we notice that expectation is very important. I subscript I is the information set available to us today. E is your expectation sign. So expectation plays a key role in exchange rate determination. That is, when people expect the exchange rate to go up in the future, it does go up. Okay, exchange rate behavior will be driven by news events. Again, you can see that I subscript T is the information available to you today. So when new information becomes available, you have to revise your information set. Okay? When the forward exchange rate F is replaced by the expected future spot rate, that is E S subscript T plus 1. Okay, when you do that substitution, you get this expression here, which says that the expected rate of change in the exchange rate is approximately equal to your interest rate differential. That is interest rate in the US minus interest rate in the UK. Now, uncovered interest rate parity states the following. Interest rate differential between a pair of countries is approximately equal to the expected rate of change in the exchange rate, which is the expression given here. Okay, the expected change in exchange rate is E, capital E, with lower e here. So this is your expected change in the exchange rate. It is approximately equal to your interest rate differential. Now, an important concept in the foreign exchange market is known as currency carry trade. Now, unlike interest rate parity, the uncovered interest rate parity often does not hold, okay, giving rise to uncovered interest arbitrage opportunities. Now, currency carry trade involves buying a high yielding currency and funding your purchase with a low yielding currency without hedging at all. So the carry trade is profitable if the interest rate differential is greater than the appreciation of the funding currency against the investment currency. Now, this exhibit 6.3, shows us interest rate spreads and exchange rate changes. Very clearly, the two are not the same, right? In black here, you see your interest rate spread. This is the difference between interest rates in the US and interest rates in the UK, if we are using the US and the UK in our example. So it is relatively stable, right? It is relatively stable. But now look at what is happening to your exchange rate change. Okay, it is very volatile. We observe wide swings in either direction, right? Look at that. Look at that. Look at that. So very clearly, those two are not the same. In other words, interest rate spread, the difference between interest rates in the US and interest rates in the UK, that difference is not equal. I mean, it's seldom, or really rarely, is that difference equal to your exchange rate change. This is confirmation that uncovered interest rate parity does not hold, right? Now, what are some of the reasons why we may observe deviations from interest rate parity? Okay. First, we note that interest rate parity holds quite well, but it may not hold precisely all the time due to two main reasons. Transaction cost is one of them. Transaction cost. When you buy a currency, you pay a fee. When you sell a currency, you pay a fee, right? And also the interest rate at which the arbitrageur borrows tends to be higher than the rate at which he or she can lend. This reflects the bid-ask spread. And I've already mentioned the bid-ask spread here in the foreign exchange market. That is, when you buy a currency, right, you have to pay a price that is greater than the price that you receive when you sell the same currency. Okay? And also, there are capital controls. Governments sometimes restrict capital flows, okay, inbound and or outbound via jaw burning, and they do that by imposing taxes, okay, or by imposing outright bans, right? So because of these two reasons, transaction costs and capital controls, interest rate parity may not hold. Okay, so if you look at interest rate parity with a transaction cost, okay, this line here, this straight blue line represents your interest rate parity line. Because of transaction cost, this line will not always hold. So what you end up with is actually a band. You have this band around that interest rate parity line. Now a point such as G indicates that there are no unprofitable arbitrage opportunities. Excuse me. Yes, it indicates that there are no profitable. I'm saying point D indicates that there are no profitable arbitrage opportunities. Okay, you cannot engage in any arbitrage activity if you are at a point such as D. However, if you are at a point such as C, yes, arbitrage opportunities do exist and can be exploited. Okay, here we see deviations from interest rate parity using the case of Japan during the window from 1978 to 1981. Now, very clearly, you know, we observe wide swings here, right? That deviation is seldom equal to zero. Okay, as a matter of fact, prior to about 1979, you see the deviations were very severe, and then we observed the same severity around 1980. Okay, but then shortly after that, things seems to be relatively stable. Now, purchasing power parity, when the law of one price is applied internationally to a standard consumption basket, we obtain the theory of purchasing power parity, or PPP. Purchasing power parity states that the exchange rate between any two currencies should be equal to the ratio of the country's price levels of a commodity basket. Now, if we use a P subscript S to denote uh, the dollar price of a standard consumption basket in the US, and P subscript pound to denote the price of the same basket in the UK, the absolute version of purchasing power parity states that the exchange rate between the dollar and the pound should be as expressed here. The spot rate is simply given as the ratio of the two prices. So if you take the price in the US and you divide by the UK, you get the exchange rate between the US dollar and the British pound. When the purchasing power parity relationship is presented in the rate of change form instead of price level, as is the case in the absolute version, we obtain the relative version of purchasing power parity, which says that the exchange rate, or the rate of change, E represents the rate of change of your exchange rate. It says that the rate of change in the exchange rate is equal to your inflation differential, right? Pi subscript S is your inflation in the US, and pi subscript pound is the inflation in the UK. So the difference between those two inflation rates represents the rate at which exchange rate is expected to change. If there are deviations from purchasing power parity, changes in nominal exchange rates will cause changes in the real exchange rates, thus affecting the international competitive positions of the countries involved. So your real exchange rate is given by this expression here. Q is your real exchange rate, and it equals 1 plus inflation in the US divided by 1 plus exchange rate change times 1 plus um, inflation in the UK. Now, if purchasing power parity holds, the real exchange rate should equal 1. So this expression here should equal 1. But if purchasing power parity is violated, the real exchange rate is going to be different from 1. It could either be more than 1 or it could be less than 1. At any rate, it is not going to equal 1. Now, what is the empirical evidence? What do we know about purchasing power parity? Okay, in the real world, what is the state of the empirical evidence on purchasing power parity? Now, purchasing power parity has been the subject of a series of tests yielding generally negative results, especially over a short horizons. Generally unfavorable evidence about purchasing power parity suggests that substantial barriers to international commodity arbitrage exist, right? As long as they are non-tradables, for example, haircuts cannot be imported or exported. Housing, cannot be exported or imported. So as long as they are non-tradables, purchasing power parity will not hold in its absolute version. Now, if purchasing power parity holds for tradables and the relative prices between tradables and non-tradables are maintained, then purchasing power parity can hold in its relative version. Now, the Fisher effects. These effects were named after the famous British economist Sir Fisher. Now, the Fisher effects or the Fisher effect singular holds that an increase or decrease in the expected inflation rate in a country will cause a proportionate increase or decrease in the interest rate in the country. So more formally, the Fisher effect is written as shown here. Okay. This expression is the Fisher effect, okay, where rho subscript S represents the equilibrium real interest rate in the United States. Okay. So the Fisher effect implies that the expected inflation rate is the difference between the nominal and real interest rates in each country. Okay. This is the expected inflation in the US. It equals the difference between the nominal rate in the US and the real rate of interest in the US. Similarly, in the UK, the expected inflation is equally seen as the difference between the nominal interest rate in the UK and the real interest rate in the UK. Now, if we assume that the real interest rate is the same between the two countries, that is, if we assume that the real interest rate in the US is exactly equal to the real interest rate in the UK, if we make that assumption, then we obtain something called the international Fisher effect, which suggests that the nominal interest rate differential reflects the expected change in exchange rate. So this is the expected change in exchange rate. It is approximately equal to the interest rate differential, right? Interest rate in the US minus interest rate in the UK. Now, when the international Fisher effect is combined with interest rate parity, we obtain something known as the forward expectations parity, or FEP, which states that any forward premium or discount is equal to the expected change in the exchange rate. Okay. So again, remember that this is the expected change in exchange rate. This is the expected change in exchange rate. E, capital E, lowercase e, is the expected change in the exchange rate. and it equals this expression here. If this expression is positive, then we refer to it as a premium. If it is a if it's negative, then it is a discount. So the expected change in exchange rate equals the forward premium or the forward discount. Okay, we can combine everything here, right? Now with the assumption of the same real interest rate, right? We made that assumption earlier. If the if the real interest rate is the same in the US as well as in the UK, then we have the Fisher effect, which says that your interest rate differential um, is the same as the expected inflation rate differential, right? If both purchasing power parity and forward expectations parity holds, then the forward exchange rate premium or discount will equal the expected inflation rate differential, right? This relationship here. Okay? And exchange, if the expected exchange rate change is is equal to your forward exchange rate premium or discount, then this expression holds. This is your forward expectations, forward expectations parity. Now we turn our attention to forecasting exchange rates. Okay. Many business decisions are now based on forecasts, whether those forecasts are implicit or explicit of future exchange rates. You either implicitly or explicitly attempt to forecast future exchange rates. Now, forecasting techniques can be classified into three distinct categories or approaches. Now, the first, efficient market approach, fundamental approach, a technical approach. We will briefly review each of the three tools. Let's begin with the efficient market approach. The efficient market hypothesis, or EMH, states that financial markets are informationally efficient. If financial markets are informationally efficient, in that the current asset prices reflect all the relevant and available information. The efficient market hypothesis implies that the exchange rate will change only when the market receives new information. Now, the random walk hypothesis suggests that today's exchange rate is the best predictor of tomorrow's exchange rate. Okay, if you want to forecast exchange rate, your best independent variable or your best predictor is exchange rate today. Now, to the extent that interest rates are different between two countries, the forward exchange rate will be different from the current spot exchange rate. Now, the second tool used to forecast exchange rates is a fundamental approach. The fundamental approach uses various models to forecast exchange rates, but there are three main difficulties associated with this approach. First, one must forecast a set of independent variables, right? One must forecast a set of independent variables in order to forecast the exchange rates. And forecasting the former, that is, the independent variables, will certainly be subject to errors and may not necessarily be easier than forecasting exchange rates. Next, parameter values that are estimated using historical data may change over time because of changes in government policies and or the underlying structure of the economy. Is the economy is in recession? Is the economy in expansion? what is going on with the economy, right? And finally, the model that you use in your forecast may be misspecified. The model may be the wrong model. You might have chosen a model that is not suitable for this kind of work. Okay? So these are all difficulties that one runs into when trying to use a fundamental approach as a tool for forecasting exchange rates. And then the third way to forecast exchange rate or exchange rates is using a technical approach. Okay, so to do that, you have to first analyze the past behavior of exchange rates. Okay, you do that because you're trying to identify certain trends or certain patterns, right? And then project those patterns into the future in order to generate your forecast. Then, of course, this approach is based on the premise that history is going to repeat itself. Okay, those that believe in this approach, technicians, believe that history has the capacity to repeat itself. Okay, the technical approach is clearly at odds with the efficient market approach. Okay. The technical approach also differs from the fundamental approach in that it does not use the key economic variables like money supplies or trade balances for the purpose of forecasting. Now, two examples of technical analysis are moving average crossover rule and heads and shoulders pattern. These are popularly these are widely used in the foreign exchange market. Again, either one is an attempt to forecast exchange rates, and I'm going to touch on each of them very briefly. First, the moving average crossover rule, right? Now, in real life, traders, foreign exchange rate traders tend to compute what they call um, short-term moving averages, SMA, and long-term moving averages. In computing short-term moving averages, they may use a window of 20 days, 30 days, right? If you pick 20 days, then you will compute your moving average, over a sequence of 20 days. Now, they also are known to compute long-term moving averages. Here, you could use 200 days, for example, or you could use 250 days, right? Now, so if you pick 200 days, then again, you will compute your moving averages over that window of 200 days. And then if you plot those averages on the graph, right, you get these patterns here, right? Now, we know that short-term moving averages weigh recent changes in interest in exchange rates more heavily than long-term moving averages. Once again, short-term moving averages tend to put more weight on recent exchange rate changes compared to long-term moving averages. So because of that, the two averages are not going to be equal. Okay? Your short-term moving average is going to be different from your long-term moving average. However, you may have points in time when the two are the same, like point D, like point G. Now let's focus here on point G. You see, to get to point G, we're coming from this situation where short-term moving averages were below long-term averages, but at point G, which is a crossover point, okay, short-term averages are greater than long-term averages. So we call a point G golden cross. At point G, right, we have to buy the British pound, because the British pound is expected to appreciate, right? The British pound is expected to appreciate. So point G is very important. We call it golden cross. So here at this point you have a signal. Okay. So what are you buying here? You're buying the British pound, because what we're showing here, we're showing the exchange rate between the US dollar and the British pound. So again, once again, at point G, labeled golden cross, you buy the British pound, right? You buy the British pound. And then by the time you get to point D, right, the short-term moving average is now falling below the long-term moving average, indicating that the British pound is expected to depreciate. When something is expected to lose value, you sell it. So point D is six signals. A sell. Okay. At point D, you sell the British pound, and at point G, you buy the British pound. That's the takeaway here. Now, the second technical approach, known as the head and shoulders pattern, indicates a in an upward trending market. Okay, it indicates a reversal in an upward trending market. You can see here, right? You can see very clearly that the British pound is appreciating. At one point, it reaches a peak here, which we refer to as left shoulder, and then from there it dips. Okay, it starts to depreciate. It starts to depreciate until it gets to the support line, also known, or the support level, also known as the neck line, from which point it begins to rise again very sharply until it maxes out here. We call the head, and then from the head it begins to decrease. Once it hit that neckline or the support level, it begins to rise again until it gets to a short-term high here, which we refer to as the right shoulder. So the head and shoulders pattern is completed when the neckline or the support level is broken. Okay, this occurs when the British pound depreciates through the neckline, also known as the support level. Okay, so once this happens, a trader interprets this to mean a significant depreciation in the British pound. Okay, so this here shows a breakout. This here shows a significant depreciation in the British pound. Now, if the pound is expected to depreciate significantly, of course, what you want to do is sell it. You want to sell the pound. So, what is the performance of exchange rate forecasters? Question is, can professional forecasters outperform the market? Can they do better than the market? A very interesting study by Hun and Sabewell in 2002 found that banks, okay, as a whole, could not do better than the random walk model. Remember, the random walk model says that if you're trying to forecast exchange rates, your best predictor or your best independent variable is your current exchange rate. And so this study found that banks as a whole did not do better than a simple random walk model, although some banks did better than others, especially over the long haul. Okay, another study by Beckman and Kudash in 2017, okay, suggests that professionals have a hard time predicting exchange rates. Okay, they have a hard time predicting uncertainty regarding economic policy and macroeconomic and financial conditions. Okay. So once again, uncertainty regarding economic policy and macroeconomic and financial conditions significantly impacts professionals' forecast errors. So in a nutshell, this is what I had for you um, with respect to chapter 6. As always, I ask that you continue to stay out of harm's way. Take care of yourselves. Bye now.